Hello, everyone. Welcome to today's webinar. I'm Barbara Scafidio, editor of Prevue, and I'll be your moderator for the next hour. I want to welcome our speaker, Mike Dominguez, who needs no introduction, but I will tell you that he's the president and CEO of Associated Luxury Hotels International. I also want to thank our sponsor for this hour, Visit Lauderdale. Today's session, as with all of our webinars, is recorded and you can find it on our website. You'll also receive an email with the link, so don't worry if you miss something. And as with all of Prevue's webinars as well, you'll receive CEUs from the Events Industry Council for being here today. I will be in the chat the entire time during Mike's presentation. I'll want to get your pulse on what he's presenting, and we will leave time for questions at the end. So let's start by everybody sharing where they're from. I always love to do that. And Mike, take it away. Like I said, I was going to be brief.
All righty. Well, thank you. And as always, thanks for the invite, Barbara. And I will go ahead and get started. And I have an update that is broad and wide, looking at our industry, also taking a look at some of the things we're seeing in the broader economy, and then also taking a look at a little bit of a global perspective, as I always think that's an important piece of the puzzle that we sometimes miss. So I will go ahead and get started. And again, as Barbara said, if you have questions, we will have time for those towards the end, and we'll get to them. So let me go ahead and get started with where we are. And, things are changing and changing rapidly. So I like to start with one of my favorite quotes that was credited to Charles Darwin, but it's not the strongest, not the smartest. It's those that are able to adapt to change that survive. And I think that's more in line when I'm presenting into our business models and how we're looking at business and how it's changing. And I'll start with the U.S. hotel industry and where we're at. And this is the latest through CBRE through January of this year. It's the latest report that's come out. And you can see that occupancy continues to fall just a bit. And there's some nuance in this number. One of the things we do as an industry is talk in aggregate, which I think doesn't really get under the water to tell you what's really happening. So there's a little bit of nuance in here. But overall, this is the roll-up that you see. Occupancy is declining slightly from a year-over-year perspective. But you will see that ADR is continuing to grow and average rate is continuing to grow. So there's a reason for that, and there's a reason that that is so important. But what you'll see here is that RevPAR, which again is a metric that's a combination of occupancy and rate, and it's basically in its simplest terms, rooms revenue. You'll see that overall RevPAR is staying steady, declining slightly because of occupancy, but rate is keeping it in a positive territory. And this is relative to 2019. But you can see that US RevPAR change since basically August has remained flat or declined slightly. And it's really just been flat over the last 5 to 6 months. And that is really due to occupancy not growing, although rate still is. And again, there's a little bit of noise in this overall number. So I'll explain that in just a second. One of the things we don't talk enough about is the difference between nominal and real RevPAR. And the reason that matters is when we look at a nominal number and you see 108% in RevPAR, that just means the way to read that is 8% higher than 2019. But real RevPAR is at 88%, so we're 12% lower than 2019. And what that simply means is if you factor in inflation, and we all know the dollar today is not worth what it was back in 2019, we're not back to 2019 levels yet. And that you're going to see as I get into a little bit of the profitability and where there is a struggle, even though we've had record revenue, that overall profitability continues to struggle as an industry. Relative to 2019, RevPAR at independent and branded hotels have converged. The reason that matters, it probably makes a lot of sense that a lot of the resort communities lean independent. And now that we're back to metro areas growing and growing substantially, these two areas have converged. The only thing to take away from that is simply that we've normalized. We've now gotten to a point that we have a little more balance between the metro and the resort area. That's what's slowing down overall rate growth and overall growth in the industry, is now that it's a balanced growth between the metro areas and the resorts. The one thing I will point out is though, even though occupancy is down, I think it shows a tremendous amount of strength when you think about we are still 20% shy in our international inbound business to the United States. To know we have this kind of strength and we still haven't normalized our international traffic tells you we have a very hardy and healthy industry at the moment. RevPAR for urban locations continues to outperform. Shouldn't be a surprise. I've talked about this often for the last year. The urban areas had the largest area to grow, so they've been the fastest growing segments, which isn't a surprise. And we know the resorts came out of the chute following the pandemic, and they had some really rapid growth. That's just starting to normalize. So it basically tells us we're balancing as an industry. Airport and interstate locations are above 2019, and airport locations are outperforming. The reason this matters, that tells us business travel is now coming back, and we see some strength in business travel because that is really what drives airport performance overall. And then this is a little bit of that nuance I was talking about. So when you look at this chart, you can see this is by scale of hotel, and it is the mid-scale and economy hotels that are continuing to decline and decline at a greater pace. Specifically from November, December, and January, you can see that, but upper mid-scale, economy, and mid-scale. And the reason that matters, that's what's dragging down the overall larger average. We actually have an abundance, and they make up such a large weight of the overall hotel inventory that's what's dragging down the rest of the rates. Because if you move to luxury and upper upscale where you place your meetings, you're looking at a 4.7 and 4.3% RevPAR growth, even without an occupancy growth, which means their rates are growing a little over 5 to 6%. That is a little bit of this bifurcation. We very much have a bifurcated consumer and a bifurcated industry, and I think that's an important one to point out. I started this by saying I don't like necessarily to talk about the aggregates or we roll it up. It's necessary, but if you don't dig below that, it doesn't give you the full picture, because what it means to you is rates, when you're talking to a stakeholder, rates are still going to be a little more pressed than they would be versus the overall averages if you had a stakeholder that was reading that headline. And then if you look at overall markets, we're at that point of almost a 50-50 as far as markets that are growing in RevPAR and markets are shrinking in RevPAR. But you can see the number of markets that are declining in RevPAR is actually declining. That it was higher in December, it's lower in January. So we're starting to again reach that balance. And I do think what I would classify as some normalization overall. Even though urban locations are growing, they're not all growing equally, as you can see. The areas that are still, behind the metric, the San Franciscos and the New Orleans of the areas, or of the worlds when you're talking about the top 25 markets. But you can see the other other top 25 markets are showing a tremendous amount of strength, led by Phoenix, and then, Tampa and then Phoenix. But not a surprise, those are resort destinations, and especially in January, weather is good usually, and that also brings a tremendous amount of demand as it is their high season. One of the reasons I know that this concentration and this compression is going to remain is where we are with some of our supply chains that we're going to get to, and then our operating models. And when you look at this shows you as a roll-up, as our industry as a roll-up, we basically have revenue growth that has now normalized. We're averaging 2% growth month over month, literally for the last 6 to 7 months if you average it all out. But the challenge we're seeing, as you can see, and I have it boxed here in red, you can see that since February of 23, except for September, we've actually declined in year-over-year gross operating profit and as a percentage of revenue. So that means that we have all-time revenue, but we're continuing to decline on the profit side. This is just some of the pressure that the hotel operations are feeling, and you can see it here in pure dollars. Again, except for September, November was flat, but except for September, we've had a decline in pure operating gross operating profit dollars month by month. I can explain the why. That really has a lot to do with labor, and labor is our number one cost as a hotel, and that continues to be the pressure we're facing from a hotel industry. That's a little bit on the roll up of the industry. Again, a lot of compression, very optimistic. We're well behind on the supply chain and what's in construction. The pipeline looks great, but what's in construction is well behind normal patterns. That's going to keep compression. And what hasn't changed, the majority of hotels being built are limited service, which are that mid-scale economy or upper mid-scale segment, which doesn't put a lot of relief in play from a meeting space perspective. And that's going to continue to be a challenge for us. If we look at the overall economy, the one positive that I think you can take away, and I care less about the number than I do the trend lines, this is from the International Monetary Fund, and nowhere do you see them around the world forecasting a recession in 2024. It all shows positive growth. If you look at projections from around the globe by region, nowhere do you see a recession. We do see very anemic growth in Europe, and we knew that was going to be the case, as Germany is in a recession, but not as a overall region. So overall, you're going to see some positivity, and we're still a globally connected economy. So it does matter as far as what's happening around the world. Let's bring it back to the United States, because you know what Jerome Powell, what Chairman Powell will do, and what the central bank does here in the United States really does drive a lot of decisions and a lot of strategy around the globe. What we're seeing here, and this has been the stickiness and a little bit of the headache, is this sticky inflation that is still above the 3% range, not what the Fed wants to see. They want to see that, literally in that 2.5% range. I think they would be happy if the direction was below 3 and headed that way. But the thing I think we sometimes miss, one of the reasons this is sticky, is when you look at this chart and you see services, and the black bar is the services of this chart. Services are making up the greatest component of inflation currently today. And the reason that matters is that's really wages, and that is wages and cost of labor. That is going to remain sticky because that's not something that is going to continue to go backwards. And the one thing I think we sometimes miss is when we talk about inflation, we continue to hear that inflation is declining. That does not mean anything is getting cheaper, because what is declining is the rate of growth of inflation. And that sometimes gets missed in this conversation. The rate of growth is slowing down, so that just means things are not getting as expensive as quickly, but nothing's getting cheaper per se. It's still much higher and much elevated than 2019. So the inflation we've experienced over the last 3.5 years, that's close to 22%, is baked in forever. It's not going backwards unless we have deflation, and nowhere is that forecasted anywhere in the near future, which means we're going to continue to grow off that 22% increase, I'm sorry. But you can see we had 3.1% in February, 3.2% in March that was just released. So we're still sticky right around this 3-point range. That is going to continue to be a headache across the board. But, there's a dual mandate from the Fed, and one is managing inflation. It's two is managing that employment. And you can see that right now they're on that balance, because we haven't increased unemployment in a big way. And that is the soft landing that everybody has talked about. A soft landing simply means that we will be able to reduce inflation, the growth of inflation, without crushing employment. And so far that has happened. I love this quote from Milton Friedman. Milton Friedman was a Nobel Prize winning economist, had a brilliance about explaining the economy. And I'll tell you the one quote he has about inflation, and it just simplifies it, is all inflation is caused by government, period. And the reason he said that, and it's not a political statement, it is a statement of the only entity that can print money is the government. And inflation, in its very, very simple term, is more monetary supply than excess demand. And that is what we've seen, and that's what has made inflation rise at such a fast pace. So why is the Fed raising rates? Why is the Fed making monetary supply restrictive? Because they're trying to get that money back out of supply until things balance out just a little bit. I say that without criticism. You'll see this in a little bit further, but that oversupply of stimulus and money that was in the system is working its way out, and it takes time. But that is why we've had the inflation and the stickiness of inflation that we've experienced over the last couple of years. The positive is everybody now is anticipating, and the bet is predominantly that we will have a soft landing, not a recession coming out of this. If you look at all of the indexes together, kind of taking a Mayo Clinic approach to data, you can see that real GDP is going to continue to be positive, and then we're going to have unemployment remaining moderate and our price index starting to decline. That is all lining up in a good way. The one thing I think that is sometimes missed when you look at this chart, you can see that we actually had two declining quarters of GDP at the end of 21 and into 22. Now, we didn't want to classify that as a recession, even though that has been the definition for the past 40 years. The reason I think that is important is if that was our recession, if that was our pullback, then we're in this economic growth period that is actually really positive. So what we may have been expecting or waiting to come has already happened. It just wasn't severe, it wasn't deep, and we were able to move past it pretty quickly. But I think that's an important call out when you look at the chart and what the data is actually telling us. And when we look at all the KPIs that we look at in measuring the economy, again, less to do with where these lines are, more to do with look at how tight the band is. We are really tight with CPI, CPI, PCE, core PCE. That is a real positive because you can see between 21 and April of 22 how large that gap was. That gap was what was concerning, and now that everything is tightened up, it's telling us we're reaching a little bit of normalcy and a little bit of stability across the board. When we look at the stock market, we are in a current bull market, and you can see that we are in an expansion since 2020. This expansion has only been 2.5 years or 3 years into the making. And the reason that's important, if you look at the last 40 years, all economic expansions we have on average grow for about 7 years on average, which means we still have a couple of years minimum in this bull cycle to continue to grow, and that's very healthy. Now, when you're looking at the market, I think there's a few cautionary conversations we have to have, and one is to understand that the majority of the S&P 500 and what is moving the S&P 500 is what we call the Magnificent Seven, and these are the Magnificent Seven that are listed here. Tesla, we know, has dropped significantly, but overall, it's NVIDIA, and as NVIDIA goes, so goes the economy at the moment. But this is the reason it matters. The Magnificent Seven almost had a cumulative return of almost 80%, while all other 493 companies on the S&P 500 only returned at 17%. That's the issue. So it's so outweighted that when we look at the S&P 500, we used to be able to look at that index and know exactly what it was telling us. Today, you have to dig a little bit deeper because this is very much an AI story with these large companies. And to show you how much they're weighted, if you took those 7 companies and what their weight is on the MSCI All Country World Index, so these are all companies around the world, those 7 companies outweigh all companies that are weighted in this index from Japan, France, China, and the UK. So they have a greater weight than 4 countries and the corporations that are actually anchored there. So that gives you just a little bit of indication of how overweighted the Magnificent Seven are versus the rest of the economy. So very important right now when we're trying to read what is happening in the broader economy, that you dig a little bit deeper. Why do I care about the markets? Because 60% of US households own stock, almost 60%. That matters because that is investment, that is savings, that is 401k plans. That matters to an overall consumer, and you'll see some other numbers that I'm going to show in a minute. But as we feel is how we behave, and you feel you have a consumer that is feeling pretty good about their overall net wealth when you look at what their home may be worth and what their savings may be worth with what's happening in the market and what's happening in the real estate market as a whole. You are seeing, again, some conversations, mainly in the tech world, around job layoffs and job restructuring. You know, the first push we had about jobs 18 months ago had to do with productivity. It had to do with these companies having more employees than they ever have in their history, and they were having lower productivity. And those layoffs were to right size that. The layoffs that are happening now in the tech world are literally around restructuring around an AI push. Now, that doesn't mean AI is replacing jobs. It's that they will go into different fields of development. And if AI, we need more developers around AI, you're going to see people that may have been hired for hardware maybe shrink as more get into a software type of job and type of education. That's the shift that's going on right now. So when you're seeing this, it's an important one not to read that this is an economic issue. This is a shift issue. This is a dramatic change in what lines of business they will be producing over the next 15 to 20 years. Overall, I have a lot of optimism around the economy and where we are. And the one thing I mentioned a minute ago is how we feel is how we behave. And if you look at this is the CEO confidence index from the chief executive group, you can see the trend line, a continuing increase in CEO positivity of what the outlook looks like for business conditions over the next 12 months. And when you look at this chart, the blue line shows you improving conditions. That is an elevated line. So we have more CEOs seeing conditions improve. Worsening conditions, we have less CEOs seeing worsening conditions over the next 12 months. Again, how we behave, how we feel. I mean, how we feel is how we behave. And you're seeing this momentum in the CEO community. That's positive for capital investment. What we do see is probably the greatest KPI you can have to the meetings industry is capital investment. As capital investment continues to increase or at least remain stable, so do meetings, because meetings are investments across the board. And then you can see that here, same chart on this, the chief executive, but the third column here, you can see that all but 18% of companies are either stable or increasing capital expenditures. Again, a really healthy statement for us over the next 12 months and what that environment will look like. S&P earnings are looking good. Business confidence is down, but still very close to the 100% index. So overall, we're seeing a business community that is pretty positive. And one of the reasons that optimism is still existing is the forecast around S&P 500 earnings is expected to pick up in 2024. Earnings have been a surprise. There was an expectation that these earnings would move backwards. We haven't seen that, and we've seen earnings continue to aggressively improve. And you can see on these forecasts, there's an expectation by Q4 that we're getting into double-digit increases and large double-digit increases in overall corporate earnings. So very much a positive environment. And the one piece that has helped me remain hopeful around this environment, as you can see on this chart, this is from Pantheon Economics. The black line above shows you literally liquidity or liquid assets of corporations, and the blue line is showing you interest paid, and you can see this large gap between cash and interest. And the reason that matters is basically our companies today are cash heavy, debt light. And if you look back at 2008, it was completely reversed. We were debt heavy, cash light, and it's really why we had the Great Recession. It took us a decade to get out of that. And I think the positive of that experience is corporations have spent the last 10 years of retiring debt, making sure their cash was very positive and making sure balance sheets were cleaned up. And now we're in an environment that nobody is panicking, even if there was a little bit of a slowdown, because we're cash heavy and things are looking real positive around that. There are a lot of risks. That was the optimism part of it. Risks that are out there and that we're probably not talking enough about is the Red Sea conflict and what it's doing to shipping overall. It is a challenge for us, and it'll be a challenge for us long term, and what you can see what it could do to conditions across the board. But if you're not paying attention to what is happening with the attacks through the canal, you can see on this red line is the normal route of traffic of merchandise that would be coming through the Mediterranean Sea, through Singapore, back and forth. And the interesting part is because of what's happening currently and because of the lack of safety around the canal, you can see in the gold or yellow line, the shipping route is now going around Africa, and that is averaging 9 days to the shipping routes. Just when we were getting supply chains normalized, just when we thought supply wouldn't be impacting inflation, it is just a little bit, and you can see what is happening on a cost to ship a container from Asia to the United States. All of this could have headwinds, could keep inflation a little stickier than we want it. So this is one area of risk that we really have to pay attention to. And you can find that supply issue is even what is a discussion around a risk of a soft landing. Everything else is still remaining strong. We do know we have an election here in the United States. I think one of the things we don't talk enough about is that 60% of the world GDP will have an election this year. 40%, there's 40 elections, and it's 40% of the free world that will be having elections in this cycle. That is going to change philosophies. That is going to change literally trade partners. That is going to change how we look at business, not because of us necessarily, but because of some of the rest of the world changing as well. So that is, to me, some great uncertainty to figure out what all these elections are going to mean. And I think it's important to realize is that around the globe, people are worried about things that are very different than what we're worried about here in the United States. And you can see, for instance, in India, the number one issue at 52% is unemployment. That's not the issue here in the United States. And that really has a great impact to know that the world is looking through a very different lens than we're looking through here, even though we're all in an election cycle. China, we all thought was going to be a tailwind. China is not a tailwind. China has an economy that continues to struggle. And you can see that right now that it is continuing to be a little bit of a decline in the economy, continuing to go down. And one of the things that is most worrisome with China is a decreasing population. India overtook China as the largest population in the world last year. And if you look at what's happening with China's population, its birth rate continues to decline. Its death rate continues to increase. That means their population is continuing to decrease. China is anticipated to go from 1.5 billion people to 800 million in the next 40 years. That is a challenge for a country that has been the manufacturing engine of the world. And that is a shift in their economy. And I always say, follow the money. And if you look at what has happened, this is the first time that foreign direct investment into China actually went negative. First time in history. That is telling you that there is less foreign investment going in. That's not a lot of confidence on its growth. And you can see it had continued to decline over the last 5 to 6 years, but now it's gone negative. Guess where some of that money's gone? India. India is now the growing economy around the world. You can see that the new GDP growth is India. Now it's on a smaller baseline, but it's still the strongest growth we're seeing around the world. And if there's any headache I'm seeing or nervous about around the globe, it really has to do with foreign debt and U.S. debt. The debt as a percentage of GDP continues to get to a point that is unsustainable. It needs to at least start to moderate and move backwards. And as I've said often, these debts were easy when interest rates were 0 or negative. These debts are not easy when interest rates are sitting where they are today. And here in the United States, when you go from a Fed funds rate of 0 to a Fed's fund rate of 5.3%, we now have a debt payment on the debt here in the United States of $1 trillion a year. We are now paying more in interest payments than we are in national defense. So that is unsustainable long term, and it's just something to look at. Employment picture, just wanted to mention that workforce employment is at an all-time high. That is good. And if you look at the participation rate of those that are of the prime age labor force, again, at an all-time high. Both of those are really positive. But one of the things I don't think has been talked about enough, and I find it to be an interesting metric, is Generation Z is basically the generation that has brought back part-time work. And in our industry particularly, those part-time jobs were something that we leaned on and depended on. And what you can see here is the millennials as a full demographic from ages 16 to 19 were the generation that continued to decline as far as part-time participation work, which means they didn't work while they were in school, specifically in high school. And you're now finding a generation that is working while they're in school. And it's the highest participation rate we've seen in almost 20 years. So that is a real positive for us. I think that's real healthy for our industry because our industry is really good. The service industry as a whole is really good for part-time employment, specifically for students that need to work around school schedules. One of the other pieces that we don't talk enough about, and this is a big shift in what we've seen. We keep going back to 2019, but as a workforce, as a need, we have grown substantially since that. So when you look at this chart, you can see that in 2019, we basically had 3.5 million new business licenses. So close to 3.5 million new businesses that were opening or planned to open. What you'll see is that during the pandemic, 2021, 22, and in 23, we've averaged 5 million new businesses a year, which means we've opened 20 million plus new businesses during this time frame. And these are small to medium businesses that have driven the economy and candidly driven our recovery here in the United States. And STR has a great chart that shows that. It's the small to medium businesses that have really been driving this performance. And you can take a look at, when you look at US business applications, there isn't a decline in this metric, but you can see this large spike that took place during 2020 and now is aggressively growing moving forward. I think this is a miss in the larger conversation that small to medium businesses are growing the economy and growing the movement and growing the need for new employees. And you can see that the biggest push of this is literally in the Southeast. When you look at this chart, the density is where you see the darkness of the color in the dark blue. And you can see as the Southeast, and nobody is more on fire than the Carolinas. South Carolina, North Carolina, they are leading the charge. But what you're seeing is manufacturing is moving to the Southeast. EV batteries are moving to the Southeast. We have chip manufacturing that is moving to the Southwest and the Southeast. There is a lot of manufacturing that is now moving to this area. So that is kind of the new shift. And it's an important one, and candidly, something we see in line with some CVent metrics as well, as far as where business is being produced on the meeting side of it. From a consumer perspective, we're still a consumer-driven economy. You can see that income by the consumer continues to increase and improve, and so does consumer spending. Those lines have been symmetrical. But I do think it's interesting, and this is what everybody is playing with right now. It's important to remember that, we have now $24 trillion sitting in 401k plans, and these 401k plans now have to be withdrawn from for a boomer. Now it's 72, moving to 74, but we have a boomer audience that was the birth of the 401k plan that is now having to take this money out, yet they don't necessarily need it. And we're seeing them spend it on travel and on affluent experiences. And, it's important to keep in mind the boomers are the wealthiest and longest living generation in history. We saw affluent travel grow by 220% in 2023. And this is a really great graphic, but, households of 70 and older basically hold almost 26% of all the wealth in the United States. I say this because we've ignored this audience from a marketing perspective. We're seeing it, and this is one of the reasons luxury and upper upscale continues to perform in an impressive way, while we're having a shift in other scales of hotels. And this is a roll-up of the dollars. You can see that the Xers and the boomers is where most of the wealth is sitting across the board. And actually, 95% of all the wealth in the country is sitting with an Xer and boomer audience. And when you look at this chart, it's a great visual that in 1989, you can see the lighter shade, the money skewed younger versus older. And when you look at now at the end of 2022, you can see that the money is now skewing older versus younger. There's an 11% gap in that 55 to 69% as far as share of that wealth, while there is a decline of 7% in the 40 to 54-year-olds. So again, the money is skewing much older than younger, and that is really what we have picked up on in trends in an overall economy, and then specifically in the hotel industry. What I find interesting is when you look at what's been happening with the overall environment. I mentioned the stimulus money earlier when we talked about inflation. So you'll see that on this chart at its peak, and that's the black line, we basically had $2.5 trillion in excess savings that shouldn't have been there. And what I mean by shouldn't have been there on normal savings trend lines. And what you'll find is we released 3 stimulus bills that were almost $2.5 trillion. And you can see the large spikes here every time we had stimulus bills where the money went into savings accounts. And if you think about it, and again, I say that without a criticism, not whether we should or shouldn't, it's just that the behavior around it was we were given this money while people were still employed working at home and couldn't spend it because of lockdowns and or shutdowns. So that money went into savings accounts. Now, the reason that matters, it's been spent much slower than it was saved. And you can see that in the light blue. It is decreasing. Right now, it is the split evaporation of this money, though, because you can see the lowest 2 quintiles of earners have spent through that excess savings. Again, why are we struggling in the economy in mid-scale? Mainly due to this, but you can see that the higher earner incomes in this country not only have the excess savings, candidly didn't necessarily need it. That's where we're seeing affluent travel, luxury spend continue to be there. And then in the middle, there is still some excess savings, not as large as the higher earners, but in the middle, there is still a little bit of that, and we're seeing that balance out. This just shows you that right now the estimation is it's anywhere between a $500 million to almost $1 trillion in excess savings that's still existing. Last estimate I just saw is probably sitting closer into the half billion dollar range. Still a lot of money that's in excess savings out there. And then there's been conversation recently that you've heard the reports that the younger audiences, 39 and younger, had the largest growth of wealth during the pandemic. That is an accurate statement, but again, on a much lower baseline. So when you look at this, there is basically $133 trillion worth of wealth in the United States, and 9 trillion of it is attributed to the 39 and under. So yes, they grew faster, but they grew faster on a much smaller base. So you can see that the money is still sitting between 40 and over is where the bulk of that dollar is. I only stress that because right now it's one of those issues on how do you market to both audiences and how do you stay relevant to the people that still have the money versus an audience that will have that money further down the road. This is just an article from Fortune that's telling you that Gen Z and millennials are working several jobs to make ends meet. And, literally I had one chart that I could show you that shows you the millennials are the first generation to be at only 50% of the earnings of their parents at the same age. A lot of that had to do with gig work in the gig economy. And you're seeing that start to play itself out in this environment right now. So Generation Z, working part-time, working period. And then the millennials are working multiple jobs in some of those areas as well. I think it's important. There's a lot of competition and a lot of noise in the market and a lot of things to talk about. And I love this quote from Dara. He's the CEO of Uber, used to be the CEO of Expedia. But he talks about at some point you have to compare yourself to yourself and not any outside competition. Your competition is who I was yesterday. And I think this is a great message for all of us running our businesses. There's a lot of competition. There's a lot of noise. There's a lot of changes in the market. But I think it's important for us to keep in mind that our competition is still with us. Our competition is, can I get better? Can I get better with delivery of my experience, my service, and what that looks like in whatever business you're doing or whatever role you have? And I heard an interview with Jeff Bezos recently that I thought was interesting. I heard it recently. It's not a recent interview, but what he talked about is at Amazon, everybody looks to the future and what's changing. What he did say is, yes, they looked at that and they continue to move to that. But the one question they always asked themselves was, what's not going to change? There are certain conditions, certain human elements that will not change. How do we make sure we're perfecting that? And then we worry about what's going to change and how do we start to consume that and make that better. And the reason he stressed that is he said, what's not going to change? People are going to want a fair price or cheapest price on an item. They're going to want really easy service, and they're going to want it delivered in a fast manner. That was never going to change. And he actually said, and jokingly, he had never heard anybody say they wanted to pay more for the same item that they paid last year. So that was a focus of Amazon. How do they keep pricing down at the same time of keeping service up and keeping delivery fast? I think that's an important thing for us to think about, even in our industry. What's not going to change and what we've seen is the human behavior, the need for connectivity, the need for face-to-face. That is still in play. We see it at every conference, and it's picking up steam, and it's definitely something that is now becoming very much a focus of being experiential. And how do we become experiential? What I didn't put in on a slide, and it's still true today, food and beverage pricing is coming down, but realize it's still 18% higher than it was in 2019. That is going to continue to be a headwind. Again, things are not getting as expensive as quickly, but it's not getting cheaper. So that's going to be an important message for any of your stakeholders. Certain items are down, certain items are up. You probably saw a report today, and I've been talking about it for 6 weeks. Cocoa has tripled in price. So chocolate is extremely expensive today. That is going to continue to be a headwind for us as we continue to move through this environment. And I'm going to stop there, Barbara, and open it up for questions, because I know there's questions in there, and I'm sure we have a lot of them.
We do. We've had a busy chat going on while you were presenting, and people loved that quote.
Awesome. Awesome. I think so too. It's one that I try to remind myself of, and it's easy to get trapped into what somebody else is doing, but that shouldn't alter your strategy. It shouldn't alter your focus. Stay focused on what you're doing.
Yeah, and compare yourself to yourself.
Yep.
So of course it's an election year, so the first question will be that. Specifically, this person wanted to know if the outcome would possibly have an impact on international inbound traffic.
No. No, I think we overread that. What we do find is that the elections have very little impact on our numbers, by the way. I had one chart that I did not show, but if you go back over the past elections, and even in 2016, we continued to grow in RevPAR, and we grew consistently in RevPAR for 4 consecutive years after that until 2020. But what I thought was impressive is going back to every election back to 2004, we grew every year afterwards. And that after the election, or in that election year. So everybody thinks about 2 things. One, that's a great question. 2, the election year doesn't make our industry tighten up. It doesn't. We talk about it to death. But if you look at RevPAR, we've continued to grow. The only time that doesn't hold true is in 2008. We actually declined from 2007. But we can't forget that Lehman Brothers exploded in September of 2008, which means we lost the entire 4th quarter of 2008. That had to do with Lehman Brothers. That had nothing to do with an election happening. I think the rest of it is a lot of narrative. It's a lot of noise that's out there. We don't necessarily see that. Where we do see international travel being impacted has nothing to do with the election. It has to do with the fact that if you need a visa to get into this country, it's over 400 days to get one. That's a problem. Right. And we have become one of the hardest places to get to, because we are so inefficient right now as a government to get that process cleaned up. And that is something we focus on the U.S. travel side of it. But I think that has a bigger priority. And by the way, because of that, I've talked to planners recently that I've actually had a phone call just last week with an international planner, and they told me U.S. travel has an ability to connect a group that has a large international audience to the State Department so that we can fast track it and not lose that group. I was talking to a planner for the last 18 months. They've avoided the United States because of the visa issue, because they have such a contingency. That's why we were having the call, because I was calling, or we're on that call to help them expedite that. So they will have a meeting in the United States and know they can do that confidently and get everybody here. But I think that's a bigger outcome than it is the political season.
And it's been years. I mean, how long has this been going on?
It's been over the last 4 years. It really has been. It started with the pandemic, but coming out of it, we have been terrible at fixing it as a government.
Yeah. and certainly trade shows are
Without a doubt. International audience matters.
yeah. Steffi's on the call. Hi, Steffi. She's asking about safety. Obviously, hugely important. We had a discussion about various destinations that people felt had met in or considered safe. What do you see as the ones that you would suggest are some of the safest international destinations? You've got properties all over the world, right? Do you want to tell us do a 1 minute how high
Yeah, well, like I think it's important to go to the State Department and look at the latest updates, knowing there's a difference between an advisory and a warning. And I think to not get freaked out when you have advisories, we have advisories everywhere. We all love Paris, but Paris is one of the highest theft areas in the world. And I was a victim of it last year, where my money got swiped right out of my wallet. Yeah, and it happens, but it wasn't uncommon when you talk to other people. It happens often. Paris is known for that, and there's all kinds of tips on what you should be doing to protect yourself. I think the State Department is the best resource to go to, but to understand that many places we travel will always have an advisory. That it's looking at a warning or a restriction and understanding what those are is what we should be looking at from a risk management perspective. I think that is big. And yeah, I see the note, pickpockets are huge in Paris. I learned that the hard way because I didn't know that. But those are the things. I don't see a lot of challenges outside of that. You're going to have hotspots across the world. That's going to happen. It's obvious. You wouldn't want to be going to anything that is at war at the moment. Those are going to be really risky propositions, but it's important to know your geography. Just because there is a battle going on, in Ukraine and Russia doesn't mean you can't get to the rest of Europe, and you can't do that safely. And that's sometimes our lack of geography that kind of drives that. So highly recommend go to the State Department and look at the advisory readings.
Right. And the advisories always come out around spring break. It's get used to that. Like you said, a lot of it is noise.
And I really think people just need to be smart. When you're traveling, to be smart and be aware. And candidly, it would be no different if I was telling you you're in a major city in the United States. If you're walking around and you're unfamiliar with the place, you should be very aware, be very smart, and you should ask people where you should walk to and not walk to. Because there are always pockets in any destination, any city, that will be higher risk than others.
Well, this is a good segue into another question that I don't know who said it, put it in our Q&A box. And I've wondered about this too. The urban areas are struggling with empty spaces still. Empty storefronts where restaurants and other, services used to be. And unoccupied offices. So how is the guest experience has got to be for these urban hotels has to be impacted by that. And how, what do you see happening there? Because this isn't a short-term situation.
Well, actually, there's a big push. And what happened is, Barbara, there's the one thing, and I didn't get into it in this just for the sake of time, but the return to office and coming back to the office, the 3 or 4 days people are demanded to be back in the office, it's here and it's here to stay. And we're kind of missing that in the overall narrative. And what some of the largest cities understood is that these cities were built with the mindset that people were going to work in these cities. And that was what's going to give it, to your point, the experience to a traveler or a citywide convention. These cities are now encouraging and pushing and incentivizing people to get people back into the office. You're seeing it. If you go to New York, it feels like New York again. It really does.
Summit there. Yeah.
Yeah, except for a Friday. On a Friday, it's the best time to travel in the city because most people are going to work from home on a Friday. But Tuesday, Wednesday, Thursday, the city feels normal. And that is what every urban area is getting back to. I think there's a little bit of an overread. If you look at the U.S. Labor Department, office occupancy is only 1 percentage point off of where we were pre-pandemic. And that is continuing to grow. And I think sometimes there's a little bit of a mixed narrative, because take your large metro areas that maybe took a little bit longer to get back. They also stayed closed longer than other areas around the country. And then you go around the country and there's areas exploding and you cannot keep up with the office space that is growing. And I also think, Barbara, there's a split between two things. You heard me show you that, or you saw me show you that 20 million new businesses that have opened. That's the meeting space. Is it prime A, prime B? Who's taking the space? It may not be a company taking a whole building, but it may be 20 companies all taking different floors in that building. And I think that's a little bit of the shift in the conversation that we haven't quite addressed yet. There's one report I didn't even show that it was a report in Fortune that CEOs are planning for a full return to the office by
I
20.
remember that from
You remember that?
your last
Yeah.
presentation. Yeah.
By 2026, and this was a meeting of 2,500 CEOs, and the headline was, "Are secretly planning that it's going to be 5 days back in the office." UPS just announced it recently. Boeing just announced it recently, 5 days back in the office. The financials are already there. I don't think 5 days is the reality, but I do think there's going to be a 4-day or 3-day expectation for people to be together, be in the office. And it's not for any other reason than it's hard to build culture and it's hard to build innovation and collaboration. And by the way, the areas that are pushing that the hardest are the tech areas, because innovation does not come without being in person. You got to be in person to be able to have that innovation. And I don't mean 7 days or 5 days, 9 to 5. That I think that's gone forever. Yeah, I think that's gone forever. But I do think there's a 3 to 4 day window that everybody is kind of landing on as a sweet spot.
Right, right. Let's do one more question.
Okay.
You did speak about unemployment numbers, but this person wrote, our industry is still down considerably as far as filling service positions in hotels.
Not accurate.
What impacts are let's finish it anyway. What impacts are service levels still having on groups in which services are back to normal or close? And I mean, in the chat, people were saying service levels. I mean, that's such a sweeping statement, but
It
there are
is.
groups that are struggling with service still, and there
Well,
are others where it's back. And I think there are some services that we're coming to not expect the
right.
way we expected them previously. So can you speak to that?
Yeah, I think you need to separate two things. What's not accurate is that we're so far down. We're right now at 16.8 million people employed in the hospitality industry. Pre-pandemic, we were 16.8 million people employed. We have 1.7 jobs open per hotel in the US. Pre-pandemic, it was 1.5 jobs open per hotel room or per hotel in the US. We're right where we were. We always have jobs open, but I do think is the biggest issue is the separation between what is why service is down versus why it's not. That's not an employment issue necessarily. What I will preface this statement with, we have bodies. Now, do we have trained staff? That's a different question, because we had to put people in these roles to get them going. And that is the interesting part of it. And I did see a thing come up about AHLA, and it's not that it's wrong. I always say this, we're talking in narratives that are usually 4 to 5 months old. It's whenever they read that report. I'm talking about the latest CBRE release in service and hospitality that's showing us we're back to that. Now, our industry's bigger. By the way, we've opened up some new hotels. That's why we still have jobs open. So it's not an easy read. There's a lot of data in there. But we have the same number of people working in the industry right now, and we've caught up to that 2019 level. And by the way, as an industry, we're leading jobs every month with new jobs being added, and we're averaging about 2.9%, which means we're going to continue to grow there. I think the service discussion isn't a labor discussion. I think it's a training discussion. And that is real. That is true. I don't have a simple answer for that, because we threw people into the role and we're having to teach them the service industry. I do think that's the balance of it.
Right. So we're in a transitional period.
Very much so. And I think the statement is hard, because I think some of the areas that were, again, closed longer, that they probably are experiencing it more than the resort areas that have had more practice. Even with the people they've brought on, they've now been trained for over a year and a half. And then you had other areas that are just coming back. That's going to be a pocketed experience. But I do think by the end of this year and early 25, we're kind of balanced out on where that experience. And if you look at data surveys, by the way, the service experience continues to improve, and it continues to be much higher than it was before. Not where we were in the past, but it's getting there. It's getting close to it.
Yeah, we've clearly rebounded and are moving in the right direction for quite a while now. So
Without a doubt.
yeah, here. So thank you, sir, for taking the time to share with our audience. I'm sure if they could have applauded, you would have heard
No.
applause at this moment. But excellent hour. Thank you for being with us. Thank you so much to Visit Lauderdale, and thanks to everyone on the call for being a part of this.
No. Thank you, Barbara, as always, and thank you everybody for supporting the industry. Keep it going.
Take care, everyone.